To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
Many of you would have heard the term LIBOR, LIBOR. LIBOR. There is also something called MIBOR, MIBOR. If you want to guess, LIBOR is with respect to London, MIBOR is with respect to India. LIBOR stands for London Interbank Offer Rate. MIBOR stands for Mumbai Interbank Offered Rate. Why am I actually getting into that? Because the next interest rate management discussion, interest rate management entire topic, you'll hear terms like LIBOR, MIBOR, OIS, PLR, all these are fancy terms. There's nothing to be, it's just jargon, okay? So it is just they're simple benchmarks, okay? So you know what is repo, right? You know repo and reverse repo, the rate at which RBI lends to the banks is called as repo. Just like that, there is another benchmark, right? There is another benchmark called MIBOR. First I'll explain MIBOR, then we'll come to LIBOR. MIBOR is the rate at which banks lend to each other is called MIBOR. MIBOR. Banks lend to each other, interbank rate. So if you remember in Forex, we said there is something called interbank transactions of currency, right? The rate at which banks buy and sell currency. Same like that, interbank, banks keep giving loans to each other. So that rate is called MIBOR rate. Now what is this MIBOR? This is a rate for 1 day borrowing, 2 day borrowing, 3 day borrowing, or 1 week borrowing, 1 month borrowing, 3 months borrowing. Like that, if banks want to borrow between them for specific tenures, they quote these rates and they quote these rates to each other, and these rates are captured in a system. There is something called CCIL, Clearing Corporation of India. Right, so this is an entity which is government, semi-government, semi-RBI kind of an entity which manages this entire thing. Right, so RBI, CCIL, and the banks together, they're all the participants and players, regulators, everything these people are is part of this system. Right, so this system basically tells the rate at which banks are willing to lend to each other. Right. Now, when banks are willing to lend to each other, what is the importance of this rate for you and me as an individual? Or let us say you are Reliance Industries Limited. How is this rate relevant to you? What people do, or rather what banks do is, we discussed initially that we place deposits with SBI and then SBI lends that money to NTPC, GMR, GVK, all that, right? Just remember that fact. When let us say new entity called RIL wants to borrow from SBI. So the way SBI will think about giving the loan to RIL, the way at which they will price the loan, when they say price the loan, at what rate, at what interest rate, SBI will say, I will take my cost of funds, to that I will add a spread and that I will lend it to RIL. See, it doesn't work generally like, I will lend to RIL at some 12%. Why? Just I thought because 12 is a good number. No, it doesn't work like that. Typically what happens is, you have a cost of funds, to that you add a margin, which is your spread. For some you add credit spread, you add some kind of operating spread, then you add various other things, right? And then you quote a rate. Now market may Reliance is able to raise a bond at not at 12% but at 11%. Then SBI will say no, in let's say in debt market RIL is able to raise at 11% but SBI is offering 12%. Then SBI may say, okay, let me reduce my spread by 100 basis points. Right. So like that SBI will take decisions. But the fundamental way in which SBI lends to RIL or anybody else, even for our home loans, right, there is a benchmark rate. Right. So there is always a benchmark against which a bank measures what is my cost, what am I lending the money out. So there is a cost of funds, there is a lending rate. Cost of funds, lending rate. What is my cost of funds for SBI is the cost of funds of CASA deposit, rate at which it is raised some kind of bonds and all of that. What is the lending rate? It is the rate at which it lends to RIL or GMR, GVK, NTPC, LNT, whoever. Right. So the bank will try to maintain a spread between these two. Right. Now, how is this linked to MIBOR? What happens is, when you take large loans, typically large borrowers will say, I want MIBOR plus 5%. I want MIBOR plus 5%. Now it is not so prevalent in India, but international loans, right, are LIBOR plus X. LIBOR plus 200 basis points, LIBOR plus 500 basis points. What is LIBOR? Just like Mumbai interbank offer rate, which is for banks borrowing and lending in India, in London, the banks based out of London, for certain currencies, for some specific set of currencies, the rates at which they will borrow and lend to each other is called as the LIBOR rate. So let us take one example. Some of you, I don't know how many of you remember this, Tata Motors went and acquired Jaguar Land Rover. Tata Steel went and acquired your Chorus. Right, so Tata Group did all these major fancy acquisitions. There are a lot of other players also who did overseas acquisitions. Aditya Birla Group did some major acquisition and all that. When they had to make these acquisitions, they didn't have all the money. They did not carry all the money from India and go and give it there. Okay, it didn't work like that. What they did was they gave some kind of guarantees. Some guarantees at India level, some guarantees at the asset level. That is, when Tata acquired Chorus or Jaguar Land Rover, they pledged the assets of Jaguar Land Rover and Chorus. And they raised borrowings internationally from banks like Standard Chartered, BNP, some US banks, UK banks, all of that. They raised money, and when they raised money in dollars or pounds. They raised money out of Cyprus or Mauritius or places like that. And what they did was they said, we will borrow from these international banks at LIBOR plus 3%. At LIBOR plus 3%. So Tata Group, they will have one entity which is based out of Mauritius. That entity is borrowing from international banks at LIBOR plus 3%, and that money, that entity is using to buy out Chorus or Jaguar Land Rover. Okay, so international loans typically are benchmarked to this particular reference rate called LIBOR, LIBOR. Okay, there is a history to LIBOR, we'll come to that. Right, now international loans are typically benchmarked to LIBOR. Indian loans potentially could be benchmarked to MIBOR, but more than MIBOR, Indian loans, right, are benchmarked to something called as MCLR or BPLR. What is this MCLR, BPLR? You are again introducing new jargon. So, BPLR is bank's prime lending rate. MCLR is marginal cost of funds based lending rate. So, BPLR and MCLR are the rates for Indian banks. That is, what is my marginal cost of funds for a bank, me, State Bank of India, what is my marginal, if I have to raise let's say extra 100 crores, what is the cost of funds? Okay, I will add a spread to that and I will lend it to somebody. Okay, Tata Group has approached me, I will say MCLR plus this much, or prime lending rate, that is to my best rated borrower, what is my lending rate, that is the rate. On that I will add some spread, or I will add some credit spread or reduce some spread, and I will lend to your Tata Motors, right. So these kind of benchmarks exist in Indian perspective. So if you are a home loan borrower, whenever banks change their MCLR, or whenever banks change the rate to which your home loans are linked every 6 months or 1 year, the home loan interest rate comes down. Okay, whenever they reduce the MCLR or BPLR component, and when there is a reduction in interest rate, your home loan interest rate comes down. When their cost of funds, that MCLR or BPLR goes up, your home loan interest rate increases. So if the EMI is staying constant and home loan interest rate increases, the loan tenure increases. Right, or the EMI will have to increase if the loan tenure has to remain same. So, okay, so the reason why I am trying to explain this is there is always a benchmark. Right, in case of Indian context, typically we borrow in MCLR or BPLR linked rates, whereas internationally it is more about LIBOR linked borrowing. And MIBOR is Indian equivalent of LIBOR, but it has not really caught fancy in India. It is only between banks. There are some times when borrowers also borrow at MIBOR plus things. I have done some borrowings at MIBOR plus rate, but typically it is linked to BPLR, MCLR, even whether it is home loan or large scale loans or whatever it is. International borrowings, that is when you are borrowing from outside India. Right, I told you example of Tata Mauritius raising some money for acquiring Chorus. Right, so they raised money from Standard Chartered, Citi, JP Morgan in Mauritius at LIBOR plus 200 basis points or 300 basis points or something like that. Right, so the LIBOR, and how is LIBOR determined? LIBOR and MIBOR, I said, are determined in the same manner. That is the rate at which banks are willing to lend to each other for specific periods. So theoretically, you will have how many types of LIBOR? You will have multiple types of LIBOR. You will have 1 day LIBOR, you will have 2 day LIBOR, you will have 3 day LIBOR, 1 week LIBOR, you will have 1 month LIBOR, 2 month LIBOR, 3 month LIBOR, 6 month LIBOR, 1 year LIBOR. Like that, you will have multiple variations. So some of them may not actually exist, like 3 day, 4 day. I just gave you an example. Right, but 3 months exist, 6 months exist, 1 month exists, 1 day exists, 1 week exists. So a lot of these varieties of LIBOR exist, and they are there for multiple currencies also. Right, so these rates that are quoted between two banks on a specific date, right, on that day if you are borrowing money, then you will link your loan to that day's LIBOR plus this much percentage points. You link the loan interest rate to that day's LIBOR plus this much spread, right. If LIBOR plus 300 basis points is the rate at which Tata Mauritius is borrowing from Standard Chartered Bank. So what will Tata Mauritius have to pay the interest on that, whatever 100 million, let's say they have taken the loan on 100 million, LIBOR rate let us say is 2%. So 2% plus 300 basis points is 5%. So on 100 million you have to pay 5% interest. Now if this is a 3 month LIBOR, that the 5% interest rate will be 5% into 100 million into 3 by 12, that is the interest that you will pay. If it is a 6-month LIBOR, then it means that the rest is also 6 months. That is, you will pay interest also 6 months. So, it will be 5% into 100 million into 6 by 12. So, that is how this Tata Mauritius will pay loan to Standard Chartered for the loan that it took to acquire, let's say Chorus or Jaguar Land Rover. It doesn't matter which one it is, whatever it took for some kind of acquisition, right? So, now why is this all important? Because when you do interest rate risk management, we talk a lot about fixed rate loans and floating rate loans. So, what are floating rate loans? All these that I have explained, MIBOR, LIBOR, BPLR, MCLR, right? Then you also have many other new things that have come up. All these loans are floating rate loans. What are fixed rate loans? Fixed rate loan is, you go to State Bank of India, I want a 1 month loan, it is at 10%, okay, you take it 10%. You go to, Standard Chartered Bank says, the loan is 5%, okay, 5%. It is not linked to any external benchmark. So, when it is not linked to any benchmark, but the interest rate is fixed, it's called a fixed rate loan. When it is linked to a benchmark like LIBOR, MIBOR, and all these BPLR, MCLR, these are called as floating rate loans. Now, the reason why we need to understand LIBOR even more important, or why it is even more important is, I don't know how many of you are writing exams when, but LIBOR as a benchmark is caught in a lot of scandals. So, it is actually being phased out. World over, it is being phased out. There are new benchmarks that are coming up. Let us see what those new benchmarks are.